This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. So today we tried out a new format, which I thought was pretty good. We talked about two current topics, a portfolio management topic, a financial planning topic, and the worst advice that we heard last week. So I felt good having structure, actually.
Yeah, I think we've been looking for that structure. Just it helps us prepare. I think it helps people understand where we're going with each different episode. And there's some good stories that came out this week. You know, lawsuit against closet index funds, all this talk about IPOs lately. I think we did a good discussion around which accounts to use in what situations.
Yeah, feel free to give us feedback. Let us know what you thought of the episode. As always, we appreciate people sharing the podcast with other people that they think will find it interesting. It blows my mind. We're getting per episode around 1,300 downloads now, which is, it's a lot.
It's a lot. And it's even going back right to episode 1 last August, which I find amazing.
So the fact that people are listening is...
I think we're almost up to 3,000 downloads a week.
3,000 a week?
Yeah, 3,000 a week. We're closing in on, yeah.
Wow, I didn't see that data point. Anyway, we very much appreciate people listening, and we obviously hope the content is useful to you.
I love the feedback.
Yeah, feedback's been great.
Thanks.
Welcome to episode 42 of the Rational Reminder Podcast. Just Cameron and I today, no guest.
We got the system down now. Every other week we have a guest.
Yeah, that's going to continue.
However, you do want to adjust the format a bit, you were thinking going forward.
Yeah, so for the episodes where it's just us, we're just going to make a small tweak to sort of try and keep it relevant to people.
And less factors.
Yeah, we're going to take a break from talking about factors. We've become known as like the factor podcast, which isn't necessarily what we want to be.
So we're going to stop using the F word as much.
I used it in a non-investment context in my notes. And I was thinking like, oh, geez, people are going to get upset I said fact. So for the format, we're going to try doing 2 current topics, which is less. We've usually been doing sort of like 5.
Yep.
And then 1 portfolio topic. So portfolio management investing topic, 1 financial planning topic. And then we're going to finish off each episode with the worst advice that we heard in the previous week.
I love that one because there's so many that come up in our day-to-day world that it's going to be fun to have that one added in.
Yeah. So one of the things that happened, and this isn't one of our, I'm breaking the format already, but it's not one of the stories that we're going to talk about, but the Ontario budget came out, and one of the items that was in there was title protection for financial planners and financial advisors. They didn't specify what that means. Like, what are they actually going to do? It said that they still have to work on the framework.
Right. And it will take a number of years. But the point is to make it more in line with, I think, Quebec, right? Which is the only province now that does have protection or standards for using the title financial planner or financial advisor.
Yeah.
So I think it's a good thing.
It is a good thing. It won't affect us at all because I think they're trying to make the title line up with credentials. But here most of us that face clients are financial planners or CFPs or CIMs or CFAs.
Yep.
So it shouldn't affect us at all. But for the industry as a whole and for consumers, I think it's definitely a good thing.
Yeah, because now you can just call yourself a financial planner and you're in business, right?
That's right.
It's that easy.
Or financial advisors even.
Yeah.
Even worse, arguably. Okay. So the couple of stories we're going to talk about. First one is closet index funds, which is an issue that's been known in Canada for a long time. But right now there's a class action lawsuit that's been put forward again by 2 different law firms against 2 specific funds.
Yeah, I was really surprised by this, actually. I mean, we've known there's been closet index issue, especially when you're managing a big fund in Canada. But to actually go and file a class action lawsuit, I wonder what the real motivation is.
Well, they want to make money. The law firm wants to make money.
But are you trying to make a statement? Like, do you really think they can win? Do you think they can pull this off? And like, where does it stop? Do you sue the industry for promoting active mutual funds over reasonably low fee index funds?
Well, it's all about active share, right? That's the whole thing. Active share is it's a measure of how different are you from the index.
Yeah, I get that for sure.
So if a fund's got low active share, there is a pretty reasonable argument to say, well, you're just charging active fees to be the index.
Right.
And that's not right. And that's not good for consumers. But I think that the main issue, especially for the Canadian bank mutual funds, which are massive, and this is what the lawsuit is proposed against, is the RBC and TD Canadian equity funds. But you start talking about the Canadian market, which is relatively small.
And these are big portfolios.
2.5 billion and 5 billion.
Yeah.
So where do you go? Like at some point, you're going to be the index because you have so much money to invest, and Canada's a relatively small pool of opportunities.
Yeah.
Hard to be different from the index and be diversified. So yeah, what's worse? But then it creates the argument of, okay, so you just index and charge.
Their raw MERs, I guess, pre any sort of advisor compensation is 1% for TD and 0.77 for RBC.
Yeah.
So I guess the argument is you can go buy an index fund for a fraction of that.
And buy XIC for whatever it's at, 10 basis points or something.
So it's that spread that is really being overpaid.
And I think fund managers, like the people who are managing those funds, when you think about what their incentives are, they don't want to underperform the index, and they especially don't want to dramatically underperform the index.
Therefore, they can't be too different from the index. Otherwise, you have career risk, I would guess.
Exactly. There was research done on this in 2016. I didn't actually like the paper very much because I didn't like the paper was saying that active share actually predicts outperformance. If you find high active, you remember that paper?
Yep.
You find high active share funds, they're actually going to do better. Anyway, didn't like that conclusion of the paper because it was later disproven by somebody else very quickly.
But it's used often to promote active funds in Canada by advisors.
But one of the outcomes of the paper that's interesting in the context that we're talking about is that they looked at the Canadian market and found that 37% of Canadian equity mutual funds are closet index funds, meaning they've got low enough active share that they're basically the index.
Yeah, it's really interesting because I'm not sure they are closet index funds deliberately. It's just a function of size and the Canadian marketplace. Like what else could they be? So I guess the point of the lawsuit is, well, you better come clean and therefore say you're an index fund and revamp it, which would dramatically cut profits in those funds for the banks. This is a
lot
huge
of money.
Profit margin.
That's a lot of money.
It's a lot of money.
On a fund that size.
It'll be neat to see what happens.
I looked at the regression coefficients. I know we're not supposed to talk about factors, but different context. I did look at how different are these funds from the market from a factor perspective. And they're both pretty much perfect market exposure, market beta of 1, and minimal exposure to other factors. And they've got large negative alphas, which you'd expect from...
It's exactly what you'd expect across the board.
They looked at, from a factor perspective, they looked a little bit different from the index, but not that much different, but maybe different enough that they're not a closet index fund. Like they both had value tilts. So who knows? It'd be interesting to see if it gets certified, and if it does get certified, what the outcome will be.
So a friend of ours shared an article from the Wall Street Journal about the perks that are really fueling up this IPO frenzy that's happened lately.
Yeah.
So much talk about IPOs now.
Yeah.
And I think you had a stat here that shows the IPO volume could be as big as it was back in 1999.
Yeah. So that's from the paper that we're talking about here, or the article that at least spurred us to have this part of the conversation, showed that if the proposed or the IPOs that we think are going to happen end up happening in 2019, that this could be the biggest year for fundraising, yes, like you said, since 1999.
I think Lyft is already gone, and then Uber may be coming up, Airbnb.
Uber filed their S1, so Uber's coming.
Yeah, and I've had a few people ask about Slack, so saying as soon as it goes, I want to participate.
Pinterest is another big one.
The question is, should people invest in an IPO?
And obviously IPOs aren't a new thing, but people definitely get excited about them. People want to get in on the IPO allocation, or they want to buy as soon as it starts trading. But yeah, you're right. The question is, should you invest? Like, what does the data say on IPOs?
Yeah, and so many people just want to invest based on the story of the company and have no idea about the metrics or valuations or anything.
Which arguably don't matter anyway, but yeah, I agree. I think that one of the things that people should realize is that if you own index funds, you will get an allocation. Well, not the initial allocation, but you will get IPO stocks in the index fund eventually.
Eventually.
It depends on the index.
So usually it's in the first year though, right?
Depending on the index? Depends on the index, yeah. So I looked at the methodologies for a few different indexes. S&P Total Market Index, which is tracked by XUU and ITOT. They add IPOs quarterly. So it's not infrequent.
Yeah, that's pretty fast.
And they don't look at any liquidity restraints or anything like that. For the S&P TSX Composite, which is a committee-based index, S&P Total Market is not committee-based, it's rules-based. That's maybe a conversation for another day, talking about how indexes work. But anyway, so the S&P TSX Composite adds them after 12 months. That's it. They wait a year.
Yep.
And then the FTSE Canada All Cap. So S&P TSX Composite, that's like XIC. FTSE Canada All Cap, that's VCN. Those are the ETFs that track those indexes. They add IPOs after 3 months. but they have to meet a liquidity requirement. And if they don't meet that requirement, then they wait a year as well. So anyway, the point is getting excited about IPOs is fine. You will get them in your index fund eventually. It just depends on which index you're tracking.
But sure is a lot less demand now than there was back in 99. So it is a very different time, I think.
Yeah, hope so. I hope it is. And we start talking about broad data on IPOs. Like it's fine to look at, I want to get on the Uber IPO. What IPOs actually look like in a broad sense. Like what's the data on IPOs? So there's a paper that I found from 2017 called The Long-Term Performance of IPOs Revisited. Pretty telling title. It does answer the question we're asking. So they looked at 7,487 US IPOs. They found that they tend to be high beta stocks with negative exposure to the value factor.
Which is what you'd expect, their growth characteristics.
Yep. The paper also found that using the Carhart 4-factor model, which includes momentum, explains all of the underperformance of IPO stocks for the first 3 to 5 years. You'd expect that, I guess. Like it's a good model. Of course, it explains it. IPO firms continue to underperform over the first 2 years after going public, even when differences in size, book to market, and momentum are accounted for. Underperformance gradually declines, becoming insignificant beyond 2 years after going public. So that's interesting.
So they kind of take on the more normal characteristics.
So the first 2 years, you would expect on average IPOs to underperform. After that, they would be explained by the regular characteristics.
Or normal type performance expectations.
Yeah. So they concluded that there's a statistically significant and economically meaningful underperformance of IPO firms over time horizons of up to 2 years, even accounting for the usual risk factors. So that's definitely an interesting finding. Basically, it means on average with IPOs, it's probably not going to be that great. They do also talk about, though, on the initial allocation, IPOs do tend to pop. So if you can get it. If you can get in on the initial allocation, on the first day, they tend to pop.
I'd love to know how you get those allocations in today's world.
You can get them. You ask a broker, they'll try and get you an allocation, but you have to have...
But it's who gets that allocation, which broker gets that allocation. Do you have to buy a bunch of junk? And other times you get access to the good stuff.
Yeah.
I mean, that's the stories we used to hear back in the 90s.
Interesting.
So if you were a persistent buyer of IPOs, no matter what the quality was, you would get the good ones, but you had to take some of the bad ones. I have no idea if it's like that today or not.
We've had clients that have gotten some initial allocations, but you have to want to buy a lot, and you're not going to get the amount that you want.
You must have to have money there as well, manage money on the books.
For sure. And you get a pro rata allocation. Like you're not going to get the amount that you want. You're going to get proportionally the amount that you want relative to everybody else based on the amount that broker gets allocated.
Not a lot of experience there. But
people like IPOs because of the lottery effect, obviously. People are willing to accept the probability of losses for the small potential of very large gains.
Plus, it's a great story. To be able to say I got to draw down of the Slack IPO.
Yeah.
Move on to the portfolio topic for this week.
Yep. So that was the two stories we just talked about. That was the IPOs and closet indexers. We mentioned the financial planner titles as well, but that's it for the current topics. So for the portfolio topic, I thought we'd talk about the arguments against.
Now you're working on a paper for this?
No, not a paper. I just I wrote the script for a video that I'll do in the next few weeks. That's where I got some of this talking points came from. I think that I
find it quite amusing, actually, to work on making arguments against indexing.
I think I boiled it down. It wasn't this clear in my script, so maybe I need to revisit the script. But when I wrote the notes for this discussion, I think it comes down to three main arguments. The first one is index funds are risky because there's no downside protection. We'll dig into more of each of these more in a sec. You get no control over your holdings, which is maybe another expression of the first one, but it's different enough that it's worth talking about separately. And then the last one is that a skilled active manager will always beat an index fund. So those are the three reasons. And obviously
we hear this all the time. So when clients transition to us from where they are now, this is often the arguments that they will hear from the advisor that's losing the business.
Oh, yeah.
And quite forcefully. And it causes often a lot of stress for people when they go through this.
So let's dig into each one of those reasons. Index funds are risky. Like I mentioned before, that you have to infer from that there's an alternative. Index are risky relative to something. And the idea would be that they're risky relative to an active manager who can do stuff like protect your downside. So that's been studied, of course. Vanguard looked at it in a 2018 paper, and they looked at U.S. mutual funds, found that they looked at a handful, I can't remember how many, a handful of historical bull markets and bear markets. They looked at in each bear market, what percentage of active managers outperform the index. Same thing for bull markets. And they found there was nothing statistically significant. There was nothing obvious, but they found that in some bear markets, more than 50% of active managers outperform, but in other bear markets, more underperform. And they're, like I said, nothing statistically significant.
Which is kind of what you'd expect.
It's just random.
But if you were that good, there should be a significant difference in returns.
It's a significant difference, but it's also the skill thing where if you're that good, it should show up in subsequent bear markets. So the Vanguard looked at that too. They took the funds that did well in bear markets and said, how did they do in the next bear market? Zero relationship.
Right.
Which is, again, what you would expect based on what we understand about financial markets. So anyway, no merit to that. The idea that index funds are risky, and I've heard financial advisors be very passionate about this. Like tell their clients, well, index funds, that you've got to understand they're very risky.
Because they own everything.
You own all the stocks.
All the bad stuff too.
Well, that takes us to the next argument against index funds.
I know.
So you get no control over your holdings, which is obviously true.
And think of the emotion behind that. Everybody wants control. I mean, that's the main driver, I think, for having active management. You want to control what you can.
Yeah.
Index funds, you have no control, which I totally disagree with. But
again, it comes back to what is the alternative? If you don't want to own all of the stocks because you want to avoid the bad ones and buy the good ones, well, the question becomes, what is a good stock? And I think that the most interesting way to think about that is that there's a huge difference between a good company and a good stock.
Yep.
Because a good company may not have good stock returns.
Right.
And that happens. There's one data point that I found that from 2010 through 2017, so this is just speaking to the quality of a company versus the quality of a company's stock returns. From 2010 through 2017, Google, Apple, Amazon, and Netflix, over that time period, explosive growth, as everybody knows. And over that same time period, Domino's Pizza destroyed their stock returns.
It's amazing.
Didn't just do a little bit better, like dominated them. Barely even comparable on a chart.
Yeah.
So that speaks to that point. And then there's all the data around the number of stocks that drive market returns. So you look at there was a study from a couple of years ago that looked at all of the stocks that had ever been included in the CRSP index. So Center for Research and Security Prices, 26,000 stocks that had been at some point in the index from 1926 through 2017, I think it looked at.
Yeah.
2015. So only 1,000 of those 26,000 stocks were responsible for all of the return in excess of T-bills.
And that's kind of the data point we talked about 2 weeks ago, I think.
It is.
So few stocks were responsible for all the returns. And you never know which ones are going to be. And you think about it intuitively, all these stocks in the market are traded so actively every day, all day, by all similar participants. All the information is priced in there. Why would you expect necessarily one to outperform the other?
Yeah.
Or anyone to have that ability to find that one.
So there's really no merit to that argument either, that you get control over your holdings by not being in an index fund. That's true, but there is zero benefit to that. And I think that the other aspect of that point is that you end up with, well, this maybe is better to talk about with the first point, with index funds being riskier. When you introduce active management, you're introducing a whole other level of risk.
Correct.
Because now you're not just taking on the risk of the whole entire market. You're saying, we think this subset is going to do better, which statistically, based on the data we just talked about, is extremely unlikely. But now you're taking on that risk that this subset is going to be better, even though statistically it's much more likely to be worse. And that's active risk. So now you're taking market risk, but you're also taking active risk.
And the other risk you're taking too is, will that manager be there for the long term?
It's active risk. It's all part of the same bucket of risk.
But we've seen managers, I even poked through a couple of fund companies this morning that I used to use years ago with all the star managers we used to meet at the luncheons. I couldn't find one manager that I recognize the name of from 15, 20 years ago. Not one. Well, what do you do with your business? How do you manage clients' money in that kind of environment?
Yeah.
Yet those websites are still full of people that are being touted as the star managers today.
Wild. Well, there's a couple of data points that we have that apply directly to what you just said. I think the other thing, last point on active risk, market risk is a priced risk. You expect a positive return over the long term for taking that risk. Active risk, no positive expected return. Statistically, much more likely to underperform. And you wouldn't expect on average any added benefit from taking on active risk. And that's the whole zero-sum game argument. On average, you'd expect active managers to underperform because of their higher fees.
And the last argument you have is a skilled active manager will always beat an index fund. That argument you hear all the time.
Especially when we start talking about the data, like you start talking about mutual fund data, people will always say, well, you can't talk about mutual funds because no one's going to invest in the average fund. You're going to find a good manager. And we've talked about these.
But the loaded word in there to me is skilled.
Yeah.
And humans are pattern seekers. And if you show someone a fund that has 10 years of great performance, they're going to automatically assume it was skill.
For sure.
But statistically, we don't know that that's skill.
It's very hard to know that it's skill statistically. And we've talked about these papers in the past, so hopefully it's not repetitive for people. But Mark Carhart, 1997, studied mutual fund performance, found the results do not support the existence of skilled or informed mutual fund portfolio managers. 2010, Fama and French also looked at U.S. mutual funds with more recent data, obviously. They did find superior and inferior skill in the tails of the distribution of mutual fund returns.
Yep.
But they also found that's before costs.
Yep.
After costs, even the skilled managers they're not skilled enough to cover their costs.
Shifts the whole distribution left.
So there are skilled managers, but not skilled enough to cover their costs.
Yep.
So that's interesting. And then speaking to your anecdotal examples that you were just talking about, when we're talking about skill, one of the questions is, like you were saying before, at what point, like how long is long enough? What's a long enough track record before you can determine someone's skilled? And we know statistically that data point is 36 years with 2% alpha with a 6% standard deviation of alpha. That's the statistical definition of skill at a 95% level of confidence. But then you start looking at actual managers who've had long-term success. So David Baker with the 44 Wall Street Fund, top performing U.S. equity mutual fund for the decade in the 1970s, I believe.
Right.
Not only beat the market, but beat every other fund. And then the subsequent decade, which was the 1980s, I believe, the fund lost 73% of its unit value over the time period, over the decade.
But your next example is the best one. It's the classic, the Bill Miller example.
Yeah.
15 years in a row of beating the S&P 500. And I can remember getting a book from the company. I think we may have talked about this on a prior podcast. Got a book from the company that introduced the Bill Miller Fund in Canada. And we got the book. And, years after that, whatever it was, 5-6 years after that, it was just terrible performance. And I think they got just obliterated in the crisis, right? Because he was, had a huge position in Fannie Mae.
Wow.
I believe.
Yeah, I didn't find all those details. But like you said, ending 2005, 15-year track record, phenomenal. Starting 2006, pretty much every year was terrible performance. I think he had 1 year where he beat the market in there. And then after that, he gave up.
Now, to his credit, he said that a lot of it was luck in the roadshow. I can remember him saying that back in the
interesting,
whatever it was. But the fund company spun this around to look at how great this is, and that was the message to us as quasi buyers of this fund, to look at how great it's been. But he did downplay, saying, "Look, there's a lot of luck in this." And I recently listened to a podcast with him. He's quite modest about. Yeah.
Interesting. That's not how it would be sold.
That was not how it'd be sold for sure.
Even if he's modest.
No.
Okay. So that was the three arguments that we hear about counter arguments for indexing. And I don't think any of them have any merit at all whatsoever. If anyone has better arguments that we should address in an episode, I'd be happy to hear them. Shoot us an email, I guess.
Yeah.
I'd actually be pretty curious if people do have good counter arguments to indexing. Love to talk about that.
Okay, planning topic for this week. Thought we'd talk about the cascading order of when to use what sorts of accounts.
Yeah, so account type planning, I guess I would call it. But it's just obviously in Canada, we have RRSPs, we have TFSAs, we have RESPs, we have RDSPs in some cases. We have taxable investment accounts. We have corporate investment accounts, which we're not going to talk about today. That's a whole other discussion.
Yeah.
So we'll exclude corporate from this conversation. But I think that the very first thing to think about when you're deciding, should I allocate to which account, is what's the goal for the money? If it's short term, probably not going to use the RSP unless it's for buying a house or paying for education. Or if you're
going to be in a much lower tax bracket on the sell side.
But I'm talking about but you don't want to pull out of your RSP.
Well, it depends on the situation, right? If you're really cash strapped, you might do an RSP at a high tax bracket now. And if you're going to be in a low tax bracket in a couple of years, just saying extreme situation.
In an extreme situation.
The point being, you got to be aware of what your tax bracket is going to be and what your needs are.
Yeah. And the point that you just made, I addressed the opposite side of it, where for short-term needs, the TFSA is probably better, just because when you put money in, you use up your room. When you take money out, you get the room back the following year.
Absolutely.
With the RSP, you put money in, you use up your room. If you take it out, even if it's in a lower tax bracket, the room is gone.
Gone. For your life. Yeah, it's only extreme situations, and I'm not sure I've ever recommended that, but the point is to be aware.
Yeah. And so like I mentioned, I think that the only exceptions for short-term needs with the RSP are home buyer's plan. So if you know you're going to be buying a house, it can be a good idea to use the deduction if you're in a high tax bracket, and then knowing you're going to pull the money back out to buy a home.
Just watch your limit on that, which is now $35,000, and try to get it between you and your spouse.
And it's got to be in there for 90 days.
Yeah, $35,000 each.
Yeah, it's true. $35,000 each, so $70,000 total.
That's real money, right? So,
but even then, for home buyer's plan, if you can avoid using it, like if you can come up with the cash in another savings account, use your RSP, get the deduction, great. But if you can come up with the cash elsewhere, that's better, because the longer the money can be in the RSP growing,
for sure,
tax-free.
But if you got the cash and you need a bit more to get that down payment,
right,
you might as well cycle it through the RSP, trigger the refund, then use it.
Yeah.
Again, situational issues come up.
Yeah. That's the only, and lifelong learning plan, I've never actually seen someone use it, but you can, similar to the home buyer's plan, just paying for education, slightly different amounts, similar rules.
But the best long-term account is a TFSA.
Which is confusing because it's also the best short-term account.
Right, because a lot of people say, well, I'll use my TFSA for short-term cash flows and leave my investments in my trading account long-term. It's like, no, you got that upside down. Like for many people, they'll never touch their TFSA, or if they do, it's the last thing they'll ever touch.
Yeah, so you're 85 years old, your only asset's your TFSA. You take money out, you're not affecting your government-tested benefits.
Yep.
You die, you can name a beneficiary so it passes outside of your estate.
And you avoid probate.
It's pretty clean. Yep. But yeah, so that's the TFSA. It's really good as a shorter term vehicle because of the flexibility around withdrawals, recreating new room. But it's also pretty great for being a longest term asset, which makes it, I think, a little bit confusing for people to think about.
Yep. So let's talk about the cascading, like the normal order of accounts that you would fill up. So generally speaking, it's the RSP first.
Well, it depends on your income, on your taxable income.
For sure, it depends on your income.
If we're assuming someone's got a high taxable income, I would go our RSP first. Then I would go our ESP because you get the matching grants, assuming you have kids.
Yep.
And then I would go TFSA if you have to choose.
Yep.
Obviously, the best case is you just max everything out. It's a non-issue, and then you're investing in your taxable account. But if you have to make a choice and you have a high income, I'd go RSP or ESP taxable. And if there's an RDSP in there too, that would fall in the same. What did I say? RSP, or ESP.
RESP because you get the grant.
TFSA.
And if you have a mortgage?
Oh, well, yeah. So if we're talking about the mortgage as a bucket, that starts to get pretty tricky. It starts to get pretty tricky because it depends on your asset allocation. Like if you're putting money into our ESP or your TFSA that's 50% stocks, 50% bonds, I might say pay off some of the mortgage or pay off more mortgage, be aggressive with the mortgage as opposed to buying bonds in your accounts. If you're 100% equity, I would go, well, it still depends on your asset allocation. If you're okay being more than 100% equity through leverage, then you invest in 100% stocks.
It also depends on your motivation too. Some people are very motivated to pay down debt.
I agree.
Right? So if you're more motivated to pay down debt than to accumulate in your TFSA, hammer the debt.
That's a behavioral decision.
Some people are extremely motivated to get rid of debt.
But if we're just talking about what is the most rational thing to do, it depends. The answer to your question depends on asset allocation.
Right.
What is your asset allocation? But yeah.
But it's not irrational to allow your behavior motivations to drive you.
Yeah, that's true. You're right.
I'm just making the case for the behavioral side.
Yeah. So we talked about taxable income. I think something that people don't maybe understand all the time is that if your tax rate stays identical, if it does not change between now and when you withdraw from the RRSP, your after-tax result from using the RSP and the TFSA, ignoring withholding taxes, which we'll talk about in a second, your after-tax result will be identical.
What about the refund? The refund on the RRSP?
You have to think about it a certain way. This makes sense, but you have to think about it a certain way for the math to work. So if you're 50% tax rate, if you take $10,000 and put it in your RRSP, you cannot compare that to $10,000 that you put in your TFSA. You have to compare it to $5,000 that you put in your TFSA because the RSP is a pre-tax contribution.
Right.
And I know in reality, people contribute with after-tax dollars and get a refund. You can't think about it that way. You get the refund, you can use that for other stuff, but you've got to think about whatever goes into the RSP as a pre-tax contribution.
Okay.
And if you think about it that way, then the example that I just gave.
So 10 grand in the RSP is really five.
At a 50% tax rate.
Yeah, is really 5,000 in a TFSA.
Correct.
Like your net cost is the same.
Correct. And in that case,
well, that's logical.
Yeah, it is. But so then you can use that as a decision tool where if your tax rate is going to stay identical, which you can't know, obviously, but if it is going to stay identical, then you're completely indifferent between RSP and TFSA.
In that case, the TFSA will blow it away. because you're paying tax in the RSP on the withdrawal side down the road.
If your tax rate stays the same, it's the same. If your tax rate stays the same, beginning and end, the after-tax dollar amount you'll have available to you from the RSP and the TFSA is identical. If your tax rate stays the same, 10,000 in the RSP, 5,000 in the TFSA, it grows over time.
Yeah.
And in the future, if you're still taxed at 50%, I mean, think about just 1 year. Say there's no growth. So 10,000.
But you take the money out of the RSP, it's going to be after you have to pay tax on that withdrawal.
But you have $10,000, not 5.
Oh, of course, 10 is in there. Okay, now I get you. Yes, I get you. Okay.
So that's it. So tax rate's the same, equal result. As soon as you're in a lower tax bracket or paying tax at a lower rate in the future than you are now, the RSP starts to have an increasing advantage depending on that differential. So again, you can use it as a decision tool. It depends on unknowns, like what is your future tax rate. But the point is, I guess, if you're in a higher tax bracket now relative to what you expect in the future, unknowable, I get it, RSP makes more sense.
But I'll make the behavioral argument again, which is the limits that come out from CRA for many people are really motivating just to maximize. Just keep your head down and maximize everything. Oh,
if you're maxing everything, then our conversation's irrelevant.
Yeah.
This conversation is only relevant for people that have limited cash and have to make a decision. I think that it's pretty intuitive that if you have room in your RSP and TFSA, there's really no reason to invest in a taxable account, with one exception. You know what the exception is?
I'll let you tell us.
If you're speculating on individual stocks, I would rather see people do that in a taxable account than in their TFSA or RSP. The reason being, if you put 10 grand into your TFSA and it goes to zero because you lose on the stock, or it goes to 60% of its original value, that room.
But if it happens to become a 10-bagger.
But statistically, you are way more likely.
Look who's talking about irrational stuff now.
What do you mean? That's not irrational.
Well, though speculating on stocks is not rational.
No, I agree it's not rational. But if someone is going to do it, the numbers are stacked against them that they're going to win.
For sure.
So you're more likely to lose. Therefore, you should basically plan to lose rather than plan to win.
Doing your trading account, at least you can capture the capital loss and use it against future gains.
Exactly. Capital loss, and you're not going to evaporate your registered account room.
Because those losses can be carried forward.
And on the flip side, if you do make a 10-bagger, it's at the capital gains rate. So on the off chance that you do win, it's going to be relatively tax efficient anyway, and you haven't risked your registered account room. So that's the one exception. RSP and TFSA for long term, as long as you have room, unless you're picking stocks, in which case taxable account, I would say, is better. And then just the last...
You want to make some points on withholding tax.
Yeah. So the last bit for this discussion, once we've decided, okay, we're going to put X amount to RSP, X amount to TFSA, the next question that follows that is how much of what are we going to buy? It's that whole asset. It's not even asset location, because we can assume same asset mix across all account types, but you can still decide to buy a US listed or a Canadian listed ETF in those accounts. And so for an RSP, US listed, US or international or emerging market ETFs are going to be more tax efficient in the RSP.
US listed.
US listed on a US stock exchange. The reason being, there is no withholding tax from dividends paid from a US stock or ETF to an RSP account.
Whereas a Canadian listed, there's a withholding tax that goes in the US, the Canadian fund, and you don't get that back in the RSP.
Right. So with US listed ETF of US stocks, there's no withholding tax. The really interesting one is with international and emerging market stocks, you're still losing withholding tax from the international and emerging markets countries because they're paying their withholding tax when the dividend is paid to the US listed ETF. The reason it's interesting is because the withholding tax, the withholding treaty rate is on average lower for foreign countries to the US than it is foreign countries to Canada. So you're better off getting the US withholding rates and then eliminating the US withholding tax.
We could make a whole section of the show on this topic alone.
Yeah, probably. It is kind of interesting. And I think the other big red flag, so US listed in the RSP for US and international and emerging markets, saves you a bit of tax, but obviously there are implications, like you've got to pay currency conversion costs, you've got to rebalance between currencies, all that kind of stuff. But barring that, if we ignore those costs, it's more tax efficient. And then the other one to keep an eye out for is with the TFSA. If you have US listed, you're going to lose 2 levels of withholding tax because TFSA, you don't get that preferential US withholding treatment. So you lose 2 levels of withholding tax using a US listed ETF of international or emerging market stocks, or a Canadian listed ETF that owns a US listed ETF. So in the TFSA, the best thing that you can do is Canadian listed ETF that holds stocks directly.
Once again, I can hear listeners' heads exploding now. The point is you got to watch withholding tax carefully on these things.
Yeah, well, it's not that bad. It's in a TFSA, if you hold a Canadian listed ETF that owns international stocks directly, you're only paying the withholding tax rate for the international stocks paying the dividends to the Canadian ETF.
Right.
Whereas if you hold a US listed, you're getting 2 levels of withholding tax.
Oh, I know that. I'm just saying the listeners.
That's okay. They'll get it now. We said it twice.
Okay, cool.
And one of the challenges is for emerging markets, there's one from BMO, but it's not great. Most emerging markets ETFs hold a US listed ETF. So in the TFSA for emerging markets, you're kind of out of luck. You're going to pay 2 levels of withholding tax,
which is a meaningful amount of cash.
It's like 60, 70 basis points.
At least, yeah.
Okay. So that's it for the financial planning topic. I hope that was useful for people.
So the worst advice we heard last week, market-linked GICs. This came up. I haven't heard about them in a long time, but it came up recently.
Talk about it.
Terrible stuff. Yeah, so someone owns a bunch of them and didn't really understand, but when they looked into them, they realized that there's a whole lot of complexity here. I don't really get it. And they surmised that it's probably better for the bank than it is for them. To which I said, that's a pretty fair assessment and the ones that I've looked at. And there's a ton of these out there.
Yeah.
But there is liquidity on it, so we're going to look into it and see.
Oh, there is liquidity.
There is liquidity.
Is it reasonable liquidity?
Well, that's what I have to find out. I think each one has different rules that you have to follow. I remember we had some way back that you had certain times of the year you could sell them, and it was a certain percentage of NAV, so net asset value. So I'm going to have to look into it. I don't know even which series this is, but a lot of them have this promise that you get this beautiful potential return with no downside. And I've seen all kinds of combinations over the years. We'll give you whatever, 7% of the upside each year. But if you have any one of the years is bad, that's rolled into the average, but there's no downside. So it ends up becoming this very complicated. And all people really hear is, I get some upside with no downside, and that's usually good enough to make the decision.
I think the key is you eliminate downside in most cases, but you cap upside. That's basically the essence of the product. So structured notes and market-linked GICs. You're giving up potential upside for eliminating downside.
And it locks in the money for the bank, and it pays nice commissions. So I think they're like 4 to 5% often as a commission rate on these things.
Which obviously hurts you as the investor. But I think that the lock-in period that you just mentioned, that's the biggest key to these products. Over 1 year, I might even say it's not that bad of a deal. But over 5 years, there's about a 70% chance that markets are going to be positive.
Right.
So over 5 years, in more cases than not, you're going to lose by capping your upside more than you would have gained on average from protecting your downside. And I looked at, it was a few years ago that I looked at this. I went to one bank's website that published all their structured note data. And I went and did, over the life of each of these products historically, how did they do relative to a balanced portfolio of index funds.
I didn't know you did that.
I couldn't, when we migrated our website, I think the blog post wasn't carried over, so I couldn't find it, which is a shame because there were some good data points in there. But basically the vast majority of market-linked GICs underperformed. There's like a few specific ones that like they were linked to gold stocks or something, and that happened to be a good period for gold stocks, and those outperformed. But anyway, the point is these products play to loss aversion for investors. Well, I don't want to lose money, but I don't want to give up upside. Well, this solves both of those problems. Yep. The reality is using these is you're being hamstrung by the upside cap.
Yep.
And the downside protection shouldn't mean anything to you as a long-term investor anyway. So I don't think that there are any, well, we don't use them. So no, I don't think there are any situations where I would say, yes, a market-linked GIC or a structured note is a good idea. Do you agree?
I agree 100%. Anything else you'd add?
No, I think that's good for today. Obviously, we have video today. So if you're listening, you could have been watching. And
why? I'm not sure, but you could have been.
And if you're watching, I mean, let us know how we look, I guess.
Yeah, and if you have feedback on the format of this every other week show, let us know.
Of the Guest Us?
Yeah.
I think that I like the new Us format. I thought it was good. Cool. We'll see what the listeners think, though. Feel free to let us know.